If you buy a farm, or you buy an apartment house, or you buy into a business, either one you own directly or one you own a piece of through stocks, you are buying into an asset that you expect to produce something later on.
Can you imagine what it would be like to make enough money by acquiring some assets that you could quit your job and do what you love all day, every day? Achieving financial freedom is when your investments and assets are able to cover all of your living expenses, liberating you from the boring routine of the daily grind. So, let us look at the top 6 assets you can buy to quit your job, using the advice of famous investors such as Warren Buffett and Charlie Munger. First up, real estate. Not just any real estate, but specifically income-producing real estate. Long acknowledged as a dependable investment, real estate offers a sense of stability and, over time, remarkable financial returns. Besides offering a place to live, owning a house can also generate a consistent source of income. Purchasing rental homes has several benefits. Apart from a consistent monthly cash flow, you can also profit from long-term appreciation and even use your home to buy other assets. Let us say you decide to buy a rental home for $250,000. A 20% down payment, or $50,000, is required to close the sale. You will therefore be using a mortgage to finance the remaining $200,000. In case you're interested in the figures, your monthly mortgage payment would equal around $955 at a 4% interest rate. And that's dispersed across a lovely, lengthy 30-year period. Assuming furthermore that your monthly property taxes and insurance come to $200, your entire monthly outlay will be $1,155. If you choose to rent this house for $1,500 a month, you will therefore be making $345 more than your monthly outlay. That's quite an excellent price. Thus, the extra money, what we refer to as the positive cash flow, amounts to $4,140 annually. The equity in your home increases progressively as long as you make mortgage payments. As so, rather than just going towards rent, each payment you make actually increases your ownership stake. Warren Buffett and Charlie Munger both stress the need to understand the intrinsic worth of an investment. Within the real estate market, a property's ability to produce revenue and appreciate in value over time defines its intrinsic worth. Compared to the sometimes erratic and volatile character of stocks, real estate investments usually yield more steady benefits. This choice could be highly tempting to those seeking a safer path to financial freedom. Talking about the fascinating prospects of long-term real estate appreciation. In the past, U.S. real estate prices have normally increased at about 3% per year. Just to let you know, in 5 years, your $250,000 property will be worth about $290,000 if it appreciates at a rate of 3% per year. Fairly amazing, isn't it? Together with the equity you've created through mortgage payments and the positive cash flow, this $40,000 gain in value greatly increases your total return on investment. But another good point about real estate investing is its call for less active participation. Your work is little after you find a renter and set up property management. The rental money begins to pour in on a regular basis. Now, I will quickly talk about the tax benefits of investing in real estate. Maintenance costs, property taxes, and mortgage interest may lower your taxable income. Real estate is an increasingly alluring investment choice because of its strong tax benefits, which can significantly increase your net returns. Moreover, real estate investing might offer some defense against inflation's detrimental consequences. Rents and property values typically rise along with inflation. This keeps your income's purchasing power intact. Considering that alternative investments could not keep up with inflation and lose real value, this benefit is quite significant. Simply said, when it comes to creating wealth and generating passive income, real estate may be revolutionary. Dividend-producing stocks come in second. Dividend stocks give regular cash dividends in place of typical equities, which mostly generate profits through price appreciation. Many successful investors have made this kind of investment their mainstay since it provides steady profits. The goal is to establish a steady stream of income, not merely to buy shares. You can create a steady income flow, gain from long-term capital appreciation, and reinvest dividends to expand your portfolio even more by investing in dividend-paying equities. You might want to buy stock in Johnson & Johnson, a company known for consistently paying out dividends. If you put $10,000 into the stock and each share costs $100, you would own 100 shares. Assume for now that the business distributes $4 per share annually. Dividends would so total $400 per year, or about $100 every 3 months. Reinvesting this dividend income to purchase further shares will eventually compound your earnings. Charlie Munger and Warren Buffett both frequently stress the value of holding stock in solidly performing, high-quality businesses. The capacity of a company to regularly produce profits and distribute a portion of those profits to shareholders drives the intrinsic value of dividend-generating stocks. Dividend stocks often provide returns that are more steady and predictable than those of speculative equities, which can be rather volatile. They therefore appeal to investors looking for a safer route to financial freedom. Think about the dividend growth potential over the long run. Many dividend-paying corporations have historically raised their payouts every year. A corporation that pays out $4 a share at first, for instance, might raise it by 5% yearly. In 5 years, the yearly dividend could be $5.10 per share. Maintaining 100 shares would raise your yearly dividend income to $510, increasing your yield on the original investment. Let's contrast investing $10,000 in a non-dividend paying growth stock with dividend stocks to really grasp their potential. Growth stocks are riskier and more volatile, even if they may provide greater financial appreciation. For gains, you might have to sell your shares, which could lower your future income potential and lower the value of your original investment. Conversely, dividend stocks preserve your money and let you compound growth through reinvestment by paying out regular income without requiring you to sell shares. Tax benefits from dividend stocks are numerous as well. Usually taxed at a lower rate than ordinary income, qualified dividends are a tax-efficient source of income. For example, whilst paying a higher rate on ordinary income, you may only pay 15 to 20% on eligible dividends if you're in a higher tax bracket. Dividend stocks become even more attractive investments when you consider that this tax efficiency can greatly increase your net returns. Dividend stocks also offer a market volatility hedge. Strong balance sheet corporations that pay dividends on time typically outperform speculative stocks during market downturns. This strength can keep your portfolio stable and offer a consistent source of income even in unpredictable economic times. Consider the effects of profitable dividend investing as shown by businessmen like Warren Buffett. Buffett has accumulated a significant fortune through Berkshire Hathaway by making dividend-paying investments in excellent businesses. Because those investments have given him steady cash flow and capital appreciation, he's been able to reinvest dividends and compound his returns over many years. The capacity to spread your portfolio among a range of businesses and sectors is another important feature of dividend reinvestment. This diversification keeps you from being too dependent on any one business or industry for revenue and helps to reduce risk. At number 3, we have protective bonds. Bonds are important for stabilizing your financial portfolio, even though they're not as thrilling as stocks or real estate. Bonds offer fixed interest and restore your capital at maturity, unlike equities, which may be somewhat volatile. They are therefore both a steady source of income and a hedge against market downturns. Assume you put $10,000 into a 10-year maturity corporate bond bearing a 5% annual interest rate. Interest payments total $500 a year. 10 years later, your $10,000 principal is returned to you. To reduce risk, Warren Buffett and Charlie Munger frequently promote a balanced portfolio that does include bonds. In low markets, bonds typically maintain their value better than stocks because they're less volatile. In choppy times, this consistency can offer a safe haven and help protect your money. For example, many bonds performed better than equities throughout the 2008 financial crisis, protecting investors from large losses. Think about the role bonds play in a portfolio that is diverse. Bonds, at 10% of a $100,000 portfolio, can serve as a financial anchor of $10,000. In a bull market for equities, bonds could do worse than stocks. But when the market falters, the stability of the bonds helps to balance your total returns and lower the volatility of the portfolio. Tax benefits abound with bonds, especially municipal bonds, which are frequently free from federal and occasionally state and local taxes. Their after-tax profits may therefore be somewhat appealing as compared to taxable investments. At number 4, we have profitable ventures. A business can give you a lot of financial control and good money. The possible benefits can be enormous, even though it does require more work and risk. Owning a company helps you create an asset that will increase in value in addition to income. Give franchising some thought. Franchises give you brand awareness, a tested business plan, and franchisor support. Assume for the moment that you put $150,000 into a well-known coffee shop chain. With such a franchise, the yearly average income could be about $500,000. A 10% net profit margin translates into $50,000 in profit annually after operational costs are subtracted, providing a 3-year return on investment. Charlie Munger and Warren Buffett stress the need of making investments in companies with superior competitive advantages. A major advantage that reduces risk and accelerates profitability in the setting of franchise ownership is the well-known brand and its existing clientele. Businesses provide a number of tax benefits as well. Operating costs of a company might be subtracted from your taxable income. Hiring knowledgeable managers and employees also enables you to assign daily tasks, which frees up your time and guarantees efficient company operations. Examining the effects of successful corporate ownership, consider Ray Kroc, who turned McDonald's into a major worldwide brand. Through the franchise of the company, Kroc developed a scalable concept that brought him enormous money. The 5th place goes to digital and cryptocurrency assets. Investment vehicles of today are not at all like traditional assets. Despite their volatility and risk, they present big profits and financial innovation. Over the last 10 years, Ethereum and Bitcoin have become more well-known. Blockchain technology powers virtual currencies, which operate on decentralized networks, offering security and transparency. One cannot overlook the growth of blockchain and digital assets. These are being included by more and more financial experts in a diverse investment portfolio, particularly for younger, tech-savvy investors. Your digital assets could pay you interest or dividends from stocks or bonds. Putting $10,000 into Ethereum on a site that yields 5% annually might bring in a $500 passive income. This creative way of earning produces other sources of money. Digital assets outside cryptocurrencies include DeFi platforms and NFTs. NFTs are special digital assets the same as virtual real estate and art. $1-million sales of digital art are evidenced by the thriving NFT market. NFT investing is a creative way to spread out your investments by looking for an interesting new technology and trends. 6th, we have the most important resource of all, your own knowledge and expertise. Returns on investment made in oneself can be the greatest. The information and abilities you gain are under your control and can be used for the rest of your life, unlike other investments that are subject to market conditions and other influences. Warren Buffett stresses the need for lifelong learning quite a bit.
Well, by far the best investment you can make is in yourself.
Gaining more information helps you take advantage of possibilities and make wise investment choices. Attending industry seminars, taking financial literacy courses, or reading a lot about market trends could all count towards this. For example, acquiring expertise in digital marketing could result in new business prospects, and mastering data analysis could enhance your investment strategies. Your capacity for income and degree of financial independence can be strongly impacted by the skills you acquire. All things considered, making investments in your knowledge and abilities guarantee long-term development and flexibility, which opens the door to financial independence and personal happiness. Now at the end, I have a question for you. If you could only invest in one asset for the next decade, which one would it be and why? I'm curious to read your answer in the comments section below.